If you're just going to your bank for your mortgage, there's a very good chance you're choosing the wrong type of mortgage, and it could cost you thousands of dollars. And the crazy part is, most people don't even realize it until years later. Because the truth is, some of the most common mortgages in Canada are actually the ones you should be most careful with. In this video, I'm going to break down what to watch out for and how to make sure you're not getting stuck in a mortgage that costs you later. For most people, your mortgage is the biggest debt you'll ever take on. We're talking hundreds of thousands, sometimes millions of dollars. And once you lock into a mortgage, you're typically committed for years, which means if you choose the wrong type of mortgage, it's not easy or cheap to fix later. Here's what typically happens. You decide to buy a home, and the first place you go is your bank. Maybe it's RBC, TD, or Scotiabank, and it feels like the right move. But here's the reality. By going to one bank, you're only seeing one option. And some of the mortgages offered there can actually be the ones you want to be most careful with. In Canada, there are three main types of mortgage lenders. First, you have the big banks. This is what most people know. RBC, TD, Scotiabank, BMO, and CIBC. Second, you have monoline lenders. These are lenders that only focus on mortgages, like First National, MCAP, RMG mortgages, and many others you've never even heard of. And third, you have alternative lenders, which are typically used for more unique or complex situations. Now, here is the key insight. Most Canadians only look at the first category, which means they're making a decision without seeing the full picture. So let's talk about the real difference. Banks offer convenience, familiarity, and brand trust. And when it comes to mortgage features, that's where things start to matter, because many bank mortgages come with more restrictions and higher penalties, and sometimes less flexibility. Now, here's a quick example. Some banks may only allow 10% lump sum payments per year, while many non-bank lenders allow 15 to 20%. That's double the flexibility. And here's the thing that most people don't realize. Many of these non-bank lenders are actually funded by the same big banks. It's not about safety. It's about getting a better mortgage product. Now, this is where things get really important, because some mortgages come with restrictions that can lock you into a bad situation. For example, some mortgages only allow you to break them if you sell your home. A bona fide sales clause is a restrictive mortgage condition stating that you cannot break or refinance your mortgage before the term ends, unless you sell your home to an unrelated third party at fair market value. So this is commonly found in low rate, no frills mortgages, and it prevents switching lenders for better rates or early payout. Others are set up in a way that makes switching lenders more difficult. So a collateral charge mortgage is a type of loan registration that secures your home loan and potentially other debts like HELOCs or credit cards, with a charge registered up to 125% of the home's value. It offers flexibility to borrow more later without new legal fees, but it's often harder to transfer to a new lender. And then there's cashback mortgages, which might give you more money up front, but can cost you more if you leave early. A mortgage cashback incentive provides homebuyers with a lump sum of tax-free cash upon closing, typically a small percentage of the mortgage amount, or a set amount up to $25,000. While useful for covering immediate expenses like furniture or closing costs, these mortgages usually come with higher interest rates and potential clawback penalties if the term is broken early. These are exactly the types of mortgage features you want to be very careful with. Let me simplify this for you. Here are a few types of mortgages you want to watch out for. First, mortgages with high penalties. Because if you ever need to break your mortgage early, this is where people get hit the hardest. Second, mortgages with restrictive clauses. If you can't refinance or switch lenders easily, you're stuck. And third, mortgages with limited flexibility. If you can't increase payments or make meaningful lump sums, you lose control over how fast you can pay down your mortgage. Now, this doesn't mean that these mortgages are always bad, but if you don't understand them, they can become very expensive mistakes. Now, here's the part that surprises most people. The biggest cost in your mortgage is not the rate, it's the penalty. Because in Canada, about 60% of people break their mortgage early. And depending on your mortgage, that could cost you thousands or even tens of thousands of dollars. How the penalty is calculated depends whether you choose a fixed or a variable rate. Here's a quick comparison. A fixed rate mortgage means your interest rate stays the same for the entire term. Your payment is predictable, stable, and doesn't change no matter what happens in the market. A variable rate mortgage, on the other hand, moves with the market. When interest rates go up or down, your rate changes, and depending on the product, your payment might change too. If you break a variable rate mortgage, the penalty is usually simple, just 3 months interest, that's it. But with a fixed rate mortgage, the penalty can be calculated using something called the interest rate differential, or IRD. And this is where things get dangerous. The bank compares your original contract rate, today's equivalent rate, and how much time is left on your term. And based on that difference, your penalty could jump into the tens of thousands of dollars. I've seen clients pay $20,000, $30,000, even more just to break a fixed mortgage early. So while a fixed rate might feel safe, it can be very expensive if your plans change, like selling, refinancing, or restructuring your mortgage. Choosing between fixed and variable isn't the only factor that can affect your penalty. Lenders can have different comparison rates they use to calculate the IRD. This is where banks and monoline lenders differ. Big banks like RBC, CIBC, or Scotiabank typically use their posted rates to calculate IRD, and posted rates are much higher than the discounted rates you actually got. So when they calculate your penalty, they can use an artificially higher rate, which creates a bigger gap, which leads to a much larger penalty. Monoline lenders like First National or MCAP usually use actual market rates or discounted rates that are much closer to reality. So they use a smaller rate difference, which results in a smaller IRD and a lower penalty. Now let's talk about something almost nobody focuses on: prepayment flexibility. This determines how much extra you can pay without penalties. So some lenders will allow small increases and others allow significantly more, and some even let you double up your payments. That difference alone can shave years off your mortgage because some mortgages help you get out of debt faster, while others quietly keep you in it longer. So here's a quick comparison of prepayment features between the 5 big banks. When you're choosing a mortgage, there are 3 ways you can pay it down faster, and this is where lenders are very different. First is your lump sum payment. That's how much extra you can put on your mortgage every year without penalty, usually anywhere from 10 to 20% of your original mortgage. Second is your payment increase. That means you can increase your regular mortgage payment. Some lenders let you go up 10 to 20%, while others let you double up your payment. And third, and this is one that a lot of people don't understand, is the double up payment. A double up payment means you can make an extra payment equal to your regular mortgage payment, but just when you want to. So if your payment is $2,000, you can pay another $2,000 that month without committing to it long term. So the big takeaway here is it's not just about the rate. It's about how flexible your mortgage really is if your income goes up or you want to just pay it down faster. Now this is where things get really interesting because this is the real difference between banks and monoline lenders. On the surface, they actually look pretty similar. Both let you make lump sum payments, usually around 10 to 20% per year. Both let you increase your payments, but when you look closer, monoline lenders are typically more flexible across the board. For example, with payment increases, banks usually sit around 10 to 20%, while monoline lenders can go up to 15 to 25%, depending on the product. And when it comes to double up payments, banks tend to be more structured, whereas monoline lenders are often a lot more flexible in how and when you can use them. But the biggest difference, and this is one that most people don't realize, is penalties. Monoline lenders typically have lower, more fair penalty calculations, which means banks can have a significantly higher penalty for fixed rate mortgages if you break them early. So the big takeaway here is it's not that one is always better than the other. It's that monoline lenders often give you more flexibility and lower risks if your plans change. So which mortgage should you choose? The honest answer is there is no one size fits all answer. But what you want to avoid are mortgages that limit your flexibility, increase your penalties, or lock you into situations that you can't get out of. The best mortgage is the one that fits your plan, not just the one that looks good on day one. And this is where a mortgage broker can make a big difference because instead of going to one bank, you can compare multiple lenders and avoid getting stuck in the wrong type of mortgage. So you're not just choosing what's convenient, you're choosing what actually works for you long term. If you're thinking about buying, refinancing, or want to understand your options at renewal, book a call with our team through the link below. I'm Evangeline, mortgage broker and owner of Alltrust Mortgage Solutions here in Greater Vancouver. Don't forget to hit that like and subscribe button if you found this helpful. And if you're planning to buy a home, check out my step-by-step guide on home buying next. Thanks for watching.